Hello everyone, welcome back to the channel. In today's video, we're going to take a look at the Blackrock iShares S P 500 ETF, also known as IVV. We will discuss what IVV is, what it invests in, and how it compares to Vanguard's VTS, its primary competitor. IVV stands as one of the most popular ETFs on the ASX right now, with around $3.5 billion in assets under management, and is run by the world's largest investment company, Blackrock. The reasons for its popularity owes to the fact that it is perhaps the easiest way for Australians to gain exposure to the US S&P 500 index. So what exactly is the S&P 500 index, and why is it so popular? Let's go take a look. IVV tracks an index known as the S&P 500. This is the largest and most well-known market index in all of the world. In the simplest terms, the S&P 500 invests in 500 of the largest companies in the United States. Now with that said, that means the S&P is around 80% of the entire US stock market because it doesn't include small and medium cap companies. And also, size alone is not the only criteria to get into the index. In order to be eligible for S&P 500 listing, a company has to be of a certain size. I think it's close to $10 billion right now. And also, it has to have at least 50% of its shares available for public trading. They can't be locked away by the company. They have to be available on the market and liquid. In addition, a company has to have been profitable for at least the last 4 quarters, so 12 months of being profitable. And it was due to this reason that Tesla, perhaps the most prominent recent addition to the S&P 500, was excluded from the index for quite a long time, despite having the market cap to be included, because it simply wasn't profitable yet. But with that said, that essentially leaves us with companies that are world renowned. As you can see from the top 10 constituents, have companies like Apple, Microsoft, Amazon, Facebook, Alphabet A and C, which is basically Google, Berkshire Hathaway, Johnson & Johnson, JP Morgan, and Visa. And just another note that the S&P 500 actually includes 506 constituents, just because some companies like Alphabet, Berkshire Hathaway, and Facebook, they have 2 classes of shares, so you'll have multiple listings. Like I think Berkshire Hathaway Class A shares are like $300,000 each, so most people can't buy even a single one of those. And with all that said, these are companies that are trillion-dollar plus sort of companies, and they have worldwide reach. And while the S&P 500 may be a US-based index, a lot of people would rightly argue that it does have a great deal of international representation just due to the reach of the companies in it. Like most of these companies you see here, at least in the top 10, have representation all over the world, even here in Australia, and are used everywhere. So it's certainly not just deriving profit from the United States, with the United States itself right now being the world's largest economy, a position that it's held for over 100 years at this point. And even though it may be supplanted by China in the coming decades, it's still very likely to remain one of the world's foremost economies. And looking at the composition of it, we can see that it has a reasonable spread across basically every sector. The US economy is quite diverse. However, in recent years, information technology has rocketed to the top just because of the astonishing growth of companies like Apple and Microsoft and all that sort of thing. And that's just due to their worldwide proliferation and the fact that they've more or less become transnational companies in a sense. So I'm not sure what the future holds, but I think that personally tech will continue to thrive and continue to grow, and we'll probably see this sort of dominance in the top end continue to proliferate. There's something like the top 10 companies in the S&P 500 make over 20% of the market cap, so it is a little bit top heavy. You do have these couple of companies up here, more particularly the top 5, pulling up everything just by virtue of their size. But you know, that is what it is, and the constituents you see, they're index weighted, so obviously the larger their market cap, the larger a percentage they're going to occupy within the index and hence the ETF. So Apple will have the largest share, followed by Microsoft and Amazon and so forth. But with all that said though, let's have a look at things like the performance over a long period of time and the assets under management and some of the key data points of this ETF. Looking at some of the key facts for this ETF, we can see that IVV is one of the largest ETFs within Australia. With around $3.5 billion in net assets, it is rivaled by very few ETFs that are listed on the ASX. Only VAS, STW, and maybe one or two others are larger than it with regards to assets under management, but this is definitely one of the star players with regards to broad index funds. The management fee for this one is a paltry 0.04%, so it's very, very cheap. It's domiciled in Australia for tax purposes, so you don't need to fill out a W8 form like some of the other funds. The dividends are paid out quarterly, and the market registry for this one is through Computershare. So if you want to sign up for dividend reinvestment, you go through them. And looking at some of the performance, we can see over the past year it has returned 7.42%. Over the past 10 years it has returned around 17%. And since its inception it has returned an average of 5.21%, which, keep in mind, between the years 2000 and around 2011, the S&P 500 was pretty flat in performance, so the majority of its performance has come in the last 10 years or so. Also of note, this ETF has a hedged version called IHVV, and it's basically the same thing. It has a slightly higher fee, but what it does essentially is it's hedged. So what that means in the most basic terms is if the Australian dollar appreciates in value, it'll do better than this one, whereas if the Australian dollar weakens compared to the US dollar, IVV here will do better. But that's for another video. I can get into more detail about currency hedging if people want to see that. But with that said, we'll move on now and see how all this compares to its primary competitor, the Vanguard VTS ETF. So a commonly asked question for many investors is whether to choose between IVV or the Vanguard VTS, which is the total stock market ETF. Both of these ETFs are very solid options, however they do differ somewhat slightly. IVV invests in the S&P 500, while the Vanguard Total Stock Market ETF VTS invests in the entire market. So it has a universe of around 3,500 companies compared to the 500 in the S&P 500, because it includes small cap and medium cap companies in addition to the large cap of the S&P 500. So it is a little bit more diversified than IVV. However, in terms of actual performance, it has been very similar. This past year, the VTS has performed slightly better. However, over a 10-year period, the two funds perform essentially identical. And because the VTS is tax domiciled within the United States, that makes things a little more complicated with regards to tax. You'll have to fill out a form known as a W8BEN form just for tax purposes and reporting purposes, whereas with IVV you will not have to do that because it's domiciled within Australia. And also, because it's domiciled in the United States in the case of VTS, you cannot sign up for a dividend reinvestment plan, whereas you can with IVV. Also, with regards to fees, they are both very, very cheap. IVV costs 0.4%, VTS costs 0.03%. So they are both very, very cheap, with the slight edge going to VTS. So with all that said, it basically comes down to a choice of having a slightly cheaper, more diversified fund with a little bit more of a pain regarding tax and dividend reinvestment versus IVV, which has a little bit less exposure, slightly higher fee, but is a lot more convenient when it comes to setting up an automatic reinvestment of dividends and for tax purposes. But with all that said, I'm going to move along to my final thoughts. In my opinion, IVV is one of the most simplistic and cost-effective ways to gain broad US market exposure. For investors looking for long-term international exposure, it is certainly worth some consideration. This isn't an ethical fund, it's not a niche sector fund, it is a broad, basic index fund. There's nothing really special about it. It tracks the US market on a very broad basis by taking into account the top 500 companies. It's not going to give you massive returns. It'll be average market returns. So if that's what you want over a long period of time, by all means, it's a viable means of investing. I personally have plenty of US exposure already through the FE ETF, which I've also done a video on in the past, in my Raiz Emerald account, which I also do videos on. But if I did need more US exposure, I'd personally choose IVV over VTS, just due to not needing to do the W8 forms and being able to set up an automatic DRP because, I'm lazy. But with all that said though, I hope you've enjoyed the video and found it informative. If you do like it, drop it a like. If you want to see future videos from me, please feel free to subscribe, and I will just leave by saying my name is Rich, and I will catch you guys in the next one.